Hi, this is Natalie Pace, and today's video conference is about the war in Iran. So, oil prices are skyrocketing, stocks are sinking. What should you do about it? Should you be running into oil and defense stocks? Should you be underweighting airlines, autos, and housing? How do you protect your wealth? Could there be a recession? All this and more in today's free video conference. You can access it as a podcast on Substack, and it's free, so please share with your friends. If you have any questions or you'd like information about our Financial Freedom Retreat or my private coaching where I offer an unbiased second opinion and a blueprint to a much better plan, do email us at info@nataliepace.com. All right, so let's get started. Oil prices are skyrocketing. Every time I look at them, they're higher. And the Qatar minister has said he's concerned that oil prices may, in fact, hit $150 a barrel. That would be an all-time high. And that's a big problem. So let me show you why. I'm going to go ahead and share the screen. Recessions are highly correlated with high oil prices. So what you might see here is that every time the oil prices really spike, we have a recession. That's the gray lines there. So this one is in 1990, this one was in 2001, and this one was in 2008. July of 2008 was actually the all-time high. And of course, you remember in the Great Recession, the Dow Jones Industrial Average dropped 55%, and it took over 5.5 years to crawl back to even. In the dot-com recession, the NASDAQ Composite Index dropped 78%, so $1 million went down to $220,000, and it took 15 years to come back. So this is not a buy on the dip moment in 21st century recessions. And it's important because we haven't really had a recession since 2008. The low was actually in 2009. We bought our way out of a recession in the pandemic, essentially printing up $4 to $5 trillion more than that over the course of everything. So what should you be doing now? All right, let's talk about this seriously. And I'm going to show you a few slides to help you to understand the most important thing right now. It's not jump in, jump out. It's not go in for oil and defense or, underweight airlines or even short the markets because we don't know how long this war is going to be. I just saw a quote of President Trump to Reuters where he said, look, as soon as this war is over, oil prices are going to sink again. And if they go a little high now, he's not that concerned about it. Now, of course, we are, but he's right. If the war ends quickly and the Strait of Hormuz opens up and all the trading of the oil starts happening again, oil prices will drop because demand has been dropping. This has a lot to do with everybody moving and shifting very rapidly, including China, the biggest consumer of electric vehicles. But people are choosing more in energy efficiency in their auto choices, which is, part of cutting into the profits. In fact, I do want to show you what I'm talking about. Let me show you a couple of the stock report cards here real quickly. Let's see which one pops up first. So this is airlines. Airlines were already not doing well. They didn't hedge against oil prices, probably because oil prices are largely expected to be weak outside of war. War makes them escalate. You're seeing why. Even though the US is energy independent, we produce more oil than we consume. It is a worldwide market. And of course, natural gas is highly correlated because a lot of the people that are drilling for oil are also the ones that are fracking for natural gas as well. So it's just important to know that if the war is prolonged, because the airlines have not hedged against higher oil prices, this could be devastating for an industry that is already low, very, very low credit quality, very low profit margins, very low year-over-year sales growth, and extraordinarily high debt. Let's see what's underneath that one. Here's our oil prices one. So as you can see, we're not going to see these oil prices that are sky high until they report their first quarter earnings. So we're seeing last quarter earnings, that would be the December quarter. And as you can see, because the prices are weaker, they have actually lost year-over-year sales growth. That's because the price of oil has been weak and their profit margins are pretty low. And this is another industry where, revenue is down. The 2022 was their banner year because that's when oil prices were high and gasoline prices were high. So I wouldn't necessarily bet on oil, A, because we don't know if this is going to be a prolonged war or not, and B, because of, they do have another underlying trend. It's not just that people are trying to buy electric vehicles. If the war continues and oil prices are high, that can plunge us into a recession. So it could be good for oil companies in the near term, very bad for them in, the 6 month or longer term, because if we hit a recession, then people won't take their summer vacations, they won't be driving as much. All of this is going to happen, and that will hit oil prices too, because demand will sink. We actually saw negative oil prices in the pandemic. Of course, we're not going to have a shutdown. Now, defense, this is an updated stock report card. If you would like access to these stock report cards, just email info@nataliepace.com. We're happy to email them to you. But I did update all of these, most of them either today or a few days ago. The defense industry is definitely enjoying a heyday, but its price earnings ratios are really, really high. And unless it's a very long, prolonged war, they are not experiencing a massive increase in revenue growth. Okay, and I think that what you need to be a little concerned about is that the wars are already priced in. So the minute that we took over Venezuela, everything shot to basically all-time highs. And we're also seeing very high price earnings ratios. If you don't know what a price earnings ratio is, you should, especially if you're trying to invest in individual stocks, but these are extremely high. And yeah, we are seeing some year-over-year sales growth. And this was before either one of these wars, right? Because Venezuela was January. That quarter hasn't been reported yet. So we are seeing a little bit, but it's not outstanding. Maybe the next quarter will be outstanding, but you are seeing that it seems to be very priced in with these extremely high price earnings ratios. So I would, if I were in your shoes, I had defense, I might consider profit taking. Now, the way that our system works is that you always are age appropriate, properly diversified, and you rebalance once, twice, or 3 times a year. If you have a slice, so if you liked defense before the pop-up, and now you have 2 slices because they've gone so high, you can actually sell one and keep it if you still think that defense can do well. Or you could sell both and say, great, I doubled my money. I'm happy with that. I don't, take a bet that the war's not going to last. So it's completely up to you, but we always have 4 hot slices in our sample pie charts. And in fact, those were the super performers of 2025. Our silver hot slice tripled, our Peru hot slice doubled, and clean energy was up 55%. So and this was far and above. I think Magnificent Seven was closer to like 30%, and Google was the main draw of that. So you can have hot industries, but I do think it's important to use the pie chart system because it's going to prompt you to sell high and buy low. If you just think, oh, we're in a war, I'm going to buy defense, you're buying high right now. All right, I want to show you a few other things. This one is the auto manufacturers. They weren't doing well before the war. When people have to spend more on gas, they have less money to spend on everything else. In high gas prices, we saw the auto manufacturing industry in 2008 had a complete meltdown. We had bankruptcies of 2 out of 3 of the major auto manufacturers in 2009. And they are all at very low credit quality. They have year-over-year revenue growth that's lower. And a lot of this has to do with, the Chinese are building their own electric vehicles and selling them in China and in other countries as well, including Mexico and potentially even Canada. So we're getting stiff competition in the hottest area of the auto market, which is electric vehicles. By the way, high gas prices will make everybody want to buy an EV even more. So that could be potentially okay for Tesla if it weren't so expensive already. So Tesla is a company that also had year-over-year sales growth that was lower. That has a lot to do with them having to lower the prices in order to compete. They have very low profit margins as well. And it's a company that made $7 billion. That's less than half of what they did just a few years ago. That's worth 1.5 trillion. A 369 price earnings ratio is just really outlandish, especially for a company that is losing revenue. So be cautious of the auto industry. Now, again, this is that chart I just showed you where high gas prices are highly correlated with recessions. We averted one in 2022, but that's kind of a question mark because we did have 2 quarters of negative revenue growth. And in a normal world, that would have been called a recession, but they didn't. And, we actually had with AI and data centers surprising growth since then. So basically, let me go through a few more things about what I think about oil, defense, auto, airlines, housing, etc. And let me see if there's anything else underneath here I want to show you. Okay, so part of the challenge is that we have stocks at an all-time high. Even with the pullback, they're still very close to that. We have outlandish debt in the United States, and over half of the S&P 500 is at or near junk bond status. We are actually overweighting 20% safe in our sample pie charts. So what that does is if you're 50 and you're overweighting safe, you have only 30% at risk. Now, the safe side, we've been seeing all kinds of shenanigans going on there, private credit, paper losses, all this. So we spend one full day on what's safe at our online financial retreat. The next one's in April. It's April 24th through 26th. If you want to get safe before then, again, our strategies on the safe side are earning a competitive yield, market yield, and no paper losses. So it's a really easy strategy, but doing it is tricky because there's a lot of conflict of interest if you have a managed plan. So I do think it's important for you to know exactly what you own and why. Make sure you have an age-appropriate, properly diversified plan, and that you know what's safe in a debt world so you are not being put into risky things, reaching for yield. High yield, it's like 0.5% higher than the market yield of safe. So again, don't reach for yield, especially in a high debt world. Again, we're overweighting safe because of the massive amount of debt and also because equities are just very expensive, too expensive for a recession. That's when things drop far and fast and then take a long time to recover, is when we get that combination. And we have seen it in the dot-com recession and in the Great Recession. And now we've really got outlandish debt and very elevated prices. So I also wanted to show you the performance by sector so that you could see what I was talking about when I said that, I had very few companies that I actually pick, but First Majestic was one of them. Picked that one and it's really been up. This is since we featured it. McEwen Mining's been doing well, but that's because of gold and silver, right? Also copper, but we bet on Peru, and Peru did much better than copper prices. Copper was up 32%, but our Peruvian fund doubled. And again, clean energy was up 60%. So I do encourage you to check out some blogs. I will be linking to them in the description of this video conference. So 15 Rules of the Rich, that's just standard stuff that you should know and apply. Our bragging rights with more information on our hot slices. AI says there's a 70% chance of a correction in 2026. That's based on trends of midterm elections, not factoring in this war, which and especially high oil prices, which definitely ups the probability. So again, email info@nataliepace.com. Make sure that you know what you own and why. Don't just have blind faith, and don't just be appeased with fancy words. You really have to know what you own and why. And I know a lot of people are like, well, it's too complicated. I don't understand it. Okay, well, that's what I do my private coaching for. That is what learning the life math through our financial freedom retreat is all about. This is something we all should have learned in high school. It's not rocket science. It's not even as hard as algebra. And once you learn it, then you have a good financial house. You can still have a financial advisor, but I wouldn't have blind faith because that can be a problem. So that's, one of the biggest things that I talk about in my blogs is that you shouldn't be having blind faith about this stuff. Right? So we've seen way too many times where trusting that you're going to be okay or reaching for yield has ended up with, Ponzi schemes and corporate collapses. And by the way, when we do have over half of the S&P 500 at or near junk bond status, that's a lot of risk out there that a lot of Americans don't even know about, even really highly educated ones. So important to know exactly what you want and why, whether you attend the retreat, read my books, or get an unbiased second opinion, it can more than pay for itself. It's not that expensive. So again, email info@nataliepace.com. Here's my homepage. You can also follow me on social media for our daily money tips. This is our next financial freedom retreat. And it's online, so you have no travel or lodging expenses. You can find out more, including testimonials. Gary Becker, Nobel Prize winning economist, enthusiastically has recommended these strategies a long time ago when he wrote the foreword to my first book. And we have many testimonials from people who, always thank us for learning this information. So again, call or email info@nataliepace.com. And just, again, you don't have to try to market time it or know exactly whether or not this war is going to keep going or end quickly. What you really want to do is, again, have some large cap growth, have some large cap value, have four HOTS, have some mid cap growth, mid cap value, small cap growth, small cap value. So have yourself diversified, but age appropriate. And you might even consider overweighting safe a little bit. All right. So if you overweight safe, what that means is that you are less likely to be caught off guards if the markets go down. All right. Thanks again. Call us or email info@nataliepace.com if you would like an unbiased second opinion, a blueprint for a better plan, or to attend our spring financial freedom retreat.